Hi and welcome to the fourth lesson of the Marmot Investing course. In this lesson, we will look at risk and how to reduce it. To start off, I'd like to ask you a question, and I really want you to think about it, so pause the video for a second right there. So here's the question. What is risk? Now, I hope you've paused the video, but I think I probably wouldn't be completely wrong if I assumed you said something like risk is a possibility of something bad happening. And you would actually be quite close, as the Oxford Dictionary says that risk is the possibility of something bad happening in the future, or a situation that could be dangerous or bad for you. In investing, we mainly look at three types of risk. There's the idiosyncratic risk, the systematic risk, and the systemic risk. Okay, you've got all three right there. So, the idiosyncratic risk is a risk unique to a company. A systematic risk is a risk unique to a whole economy, so not really unique. And a systemic risk is a risk that only affects a market segment or an industry. Now, imagine idiosyncratic risk would be just a company going bankrupt because of debt. Systemic risk would be if that company were Amazon, because there's a whole loads of companies that depend on Amazon, and they would suffer a great shock if Amazon went bankrupt. So that would be a systemic risk if Amazon went bankrupt. But not all the companies are as big as Amazon, so not all companies going bankrupt is systemic risk. And the third type of risk, systematic risk, is a risk that affects the whole economy. So imagine a really big bank, like in the 2008 crash, Lehman Brothers, goes bust. That affects the whole global economy. Or imagine an investment fund, like BlackRock, which is currently the biggest investment fund in the world. Well, if BlackRock went bust, it would affect everybody on this planet, and that would be systematic risk.
Before we get into the next part, I need to explain what diversification is. Diversification is what an investor does when he invests in multiple different assets at once to reduce the effect of something happening to one of the assets. For this to work, the assets need to be as independent from each other as possible. You can diversify across currencies, types of assets, different companies, countries, sectors, and much more.
It is commonly said that idiosyncratic and systemic risk can be diversified away. Now, let's look at that statement with a graph. On the y-axis, we've got the price, and on the x-axis, we've got time. Now, let's look at Company A. Company A starts there, and they go slowly up, as a normal company would do, then they fall a bit, then they go up, then they have kind of a straight, then they continue, then they have a really big low, then they come back up, and they go on like that. Now we've got Company B. B that starts at the same point, but they sink first, then they go slowly up, then they sink again, then they sink even more, then they come back up, and they end a bit above where they started. Now let's look at Company C. Company C starts at the same point, have a really big rise in the beginning, and now they're above, then they sink, then they rise again, and they end there. Now we looked at the law of averages, and the law of averages would dictate that if an index were made of those three companies, as an analogy to the S&P 500, for example, the index should move like that. Now, as we know from reality, the S&P 500 doesn't move in a straight line. The S&P 500 moves up, and then it goes down a bit, then it goes up again, then it goes up, then it goes even more, then it goes big down, then it goes up, and finishes about right there. Now, why should it be straight? Well, because the ups and downs should cancel each other out, and if they cancel each other out and you have multiple companies, then they will cancel each other out so well that the line will be straight. So, what does it show us? That the S&P 500 is in a straight line. Well, it shows us that maybe idiosyncratic risk and systemic risk were diversified away, but all the companies still depend on each other. So that means they react to each other. Because if all the companies were completely independent, the line would be perfectly straight. But since the line isn't straight, that means that if some companies move up, right there, most of the companies move up. If some companies go down, most of the companies go down. And now this is where systematic risk comes into game. There's a concept in investing we call the beta. I already mentioned the beta once or twice before in previous lessons, but now I'm going to explain what the beta really is. The beta is a measure of how much the stock's price reacts to overall market trends, or in more professional terms, the stock price reaction to the systematic risk. I'm going to explain the beta in two different ways. So I'm going to first look at the equation and then at the graph. Now if you only understand one of those explanations, that's completely fine, that's all you need. But now I'm going to get into the equation. So as we said, the beta, in words, is the stock's price reaction to overall market trends. So if we were to write it down, percent stock price change, let's say stock change, is equal to percent market change times, that's a times, beta. So as you can see, the beta multiplies with the market change to give you the percentage stock change. So if the market were to go up 1%, the beta is 2, then that will go up 2%. Now, if the beta is, that's a 2, sorry. If the beta is equal to 0.7, that change would be up 0.7%. And now if that were 4%, then 4 times 0.7 is 2.8. So that would be up, 2.8%. So that concept right there, the beta multiplied by the percentage market change is equal to the percentage stock change. The other way to look at the beta is in a graph. So if you look at a graph with the same numbers as there, percentage stock change on the y-axis and percentage market change on the x-axis, then you would have a line that goes through there. Now, most of you will probably know that equation, y equals mx plus c, where y is the value on the y-axis, so that one, that value right there, x is that value right there, m is a gradient, and c is a constant. So the constant c defines where the graph, the line, goes through the y-axis. Because if x is 0, there x is 0, if plus c is plus 5, then it will go through 5, if that were 5. Now, what we care about is m. M, in that case, would be the beta, as m is how much it rises. So if you have there 2, there 4, there 1, and there 2, that tiny triangle there would be 2 and 1, wouldn't it? So if it goes to the right 2, it goes up 1. So if it goes to the right 1, that would be 0.5. Just divide them by 2, and there the beta would be 0.5. So as you can see, the beta is a relationship between those two lines, which is personified in that gradient. So the gradient is the beta. The aim of diversification is to reduce the correlation between stocks in your portfolio. And that you can see because if one stock sinks, you don't want all of your stocks to sink, you want the rest to rise or stay the same, so that they compensate the stock that sunk. Now, the correlation between two different stocks we call covariance. I've written the formula there. Don't panic if you don't understand it. If you want to understand it, pause the video. That's the sigma notation, so that's the sum notation. There you've got the variable I, which goes up to n, and there you've got the average of x. So that would be for a series where you have multiple x's and each x has an assigned value. Now the variance is almost the same thing, but only for x. So that's how much x diverges from its mean. Now, the important thing with those two formulas is that you should know that beta is equal to covariance divided by variance. And that means that covariance is equal to beta times variance. Now, as I said, the goal of diversification is to reduce our covariance, to reduce the risk. So you want to have covariance approximately 0. If you want to have covariance approximately 0, you need either beta or the variance to be 0 themselves. But that's not really possible, because if you think about it, a beta of 0 would mean that if we have a graph and we have a company, let's say company A, just goes along like that, cruises along the graph, but then that would mean that that graph would stay the same even if the market sunk drastically. The company A would be unaffected by it because, as we saw, market changes times beta equals stock changes. So the beta is practically impossible to have 0 because every stock depends on how the market's doing. Now, we could consider having the variance 0, and that's where diversification gets really interesting.
My phone broke down and I still drew on the whiteboard, so before I could start videoing again, I have to explain to you quickly what I drew in the meantime. So what happened was that there was a graph, and that shows a simple stock, and now there's the mean line going through it, and the deviation from the mean line is the variance.
I apologize, my phone turned off, so I had to clear some storage to be able to film again. So let's continue with what I was talking about. Now I've got the mean, and variance that would be close to the mean would be close to 0. However, we can only get a variance that is close to 0, we want to approximate to 0, by diversifying. And how do we do that? Well, if we've got loads of stocks, as I showed there, loads of stocks that move along that mean, and now I've got another stock there, that one goes a bit lower, and that one goes a bit higher. As you can see, the line in the middle gets more and more thick. So we can approximate by saying that the mean of the portfolio of all the stocks there is actually there. And that would reduce the variance as those cancel out, all the peaks and lows would cancel out, and then we can get a variance that's close to 0. That would mean that the covariance get close to 0. So that would mean that the covariance get close to 0. And that's what diversification is for. It's to get the covariance close to 0 by getting the variance close to 0. Now that we've gotten the covariance close to 0 thanks to diversification, the only thing we need to do is to get the average beta of our portfolio above 1. So, if you imagine the market, that is price at time, the classic graph we know, the market has a beta of 1. And let's assume, to simplify it, that the market just rises like that. That's just to simplify it, don't worry. Now, imagine we have a portfolio, P, that has a variance that is close to 0, and it has an average beta that is, let's say, 1.5. Now, if it has an average beta of 1.5, that means that it will rise 1.5 times more than the market. So, in the end, it will rise like that. So because we've gotten our variance close to 0, in a beta, an average beta is higher than the market's, we can try to beat the market by combining those two factors, and that is only possible through diversification. Okay, so I mentioned a lot of different concepts in this lesson, so I'm going to try to summarize them to make it easier for you to understand once more in the end. So we've got three types of risk: idiosyncratic risk, systemic risk, and systematic risk. Now, we know we can try to diversify idiosyncratic and systemic risk away, and that's thanks to diversification. Now, before we look at that, let's look at that. Covariance is equal to beta times variance. Covariance is how much two stocks react to another stock's change. Variance is how much one stock's price goes away from its average rise, let's say. Now, the covariance of a portfolio, that's what the P stands for, is equal to the average beta of all the stocks in that portfolio times the variance of that portfolio. Now, we know that with good diversification, we can try to get the variance close to zero. And if we can get that variance close to zero, we can then almost eliminate idiosyncratic and systemic risk, which only leaves systematic risk. Now, systematic risk is really important because of the beta. Now, we know that the percentage stock change times the beta is equal to the percent market change. Now, if we can eliminate both of those, and we have a beta that is above 1, if the market changes by 2, we know our stock portfolio will change by, let's say it's 2, then our stock portfolio will change by 4. So that is how we try to beat the market, with a good beta, with a good diversification, and yeah. Thanks for watching this lesson all the way to the end. If you liked it, I would appreciate it a lot if you shared it with anyone who you think would be interested in it or might benefit from it. And see you very soon in the 5th video of the Marmot Investing course.